And also, if you are listening to the recording, so this is going to be a tutorial session, right? So you were provided with a lecture for Learning Unit 3. I'm just going to find out how you found the lecture, as well as, so in total you are provided 3 recordings, right? 3 recordings for Learning Unit 3. One of them is titled Learning Unit 3 Lecture. So that would be more of a summary of the entire learning unit, right? So when I give you a recording that says lecture, so just bear in mind that I'm providing with a clear overview of the entire learning unit, right? If you receive a recording that doesn't say lecture, so assume it's more of a tutorial. So some of the tutorials, um, um, we go, I go over the theory, or we go together, right? Over the theory. So you would understand now. I think you have the gist of it, you know, that there's times where we would discuss about the theory just to make sure that your understanding of the theory is reinforced, right? And then there would be a tutorial that is a practical, right? Or a practicum, as we used to call it in the past, right? So where we would do some calculations, and those kind of session is where I'm asking you to bring out your calculator, and we will actually be doing the calculation in class, right? But class, as you understand, an hour is not that much to cover everything. Okay? So an hour is not enough. And plus, you know, I don't want to go over an hour because at the end of the day, I don't want to bore you, right? So we might touch on a couple of things, but again, it's all about you keeping in touch with what we're doing, right? So I would start first by asking the class, how did you find the lecture? So for the people who are here tonight, did you manage to go through the Learning Unit 3 lecture, which was the last recording that I shared? And how did you find it? So feel free to unmute yourself, or if you are fast enough, you would like to type it. So I'm not going to insist that you actually unmute yourself, but it would be such a refresher if you can unmute yourself and just speak normally, right?
Hi, Patrick, how
Because,
are you?
yeah, Connor, I can hear.
Yeah, I didn't manage to go through all of it, but what I
Okay.
did manage to go through, it seems like it starts off quite theory heavy and then it gets very technical very quickly.
Yeah,
So it looks like you need a strong understanding of the theory before you can move on to the calculation side of it.
absolutely. No, you're correct. You're correct. So, guys, again, one of the tips that I shared is also you can go through the playback of the recording, you know, at a faster pace, but you see what works for you. If you need even to make it slower than the normal, I wouldn't blame you, right? But it's quite a very good overview, especially the last one that says lecture. Please, if you have not gone through it, and especially for all of you who are listening to this recording, please do yourself a favor. Go through it, because once you master the theory, right? And you have a lecture, like let's say a 45-minute lecture, right? And you can listen to that lecture at a fast pace because you understand, you just want to, you know, you just want to remind yourself of a couple of concepts, right? Then it becomes very easy for you not to lose focus. Remember, we, from learning unit 1 to learning unit 4, we are building a foundation. And so I'm 100% in agreement with Connor. On the theory side, you need to get a good handle of the theory, right? If you understand the theory and it makes sense to you, I'm saying you are almost half there, especially for learning unit 1 to learning unit 4, because learning unit like I said last time, learning unit 5 to learning unit 7 is only building up on the foundation you could have acquired, right? Guys, I did also share the, actually it was Agnes who shared the pairs, but I also grabbed the screenshot and I shared with you. As you can see, if we work together, again, strategy, it need to be always that time where we strategize together. So if you work well on learning unit 3 and learning unit 4 within a month, and you master it quite well, you should be ready to ace your task 2, right? And after your task 2, you will have also exactly or around a month to prepare for your final written exam on the campus. It's not that much, I can tell you. It's not that much of a time to prepare. So just ensure that you do your bit every week. So I'm going to share this only once. If you can do, let's say maybe an hour of just revising or going through the recordings, just an hour per week, right? And then you can set 1 or 2 hours extra, right? So 1 hour just to revise every recording that is out there for a particular learning unit, right, per week. And you just add 1 or 2 hours just for the practice, you should be fine. So basically what I'm saying is that just consecrate 2 to 3 hours per week for this module, all right? So I hope that that's clear to everyone, right? So let's begin here. Like I said, I'm not going to do a lecture, right? Because you do have a lecture. But if you have questions now, for all of you who've gone through the lecture, if they, in the lecture, actually, it was well done because I divided it into 3 parts. So that's how we're going to proceed at this. I see 3 parts and calculating the effective rate is the last part, right? Another part is obviously the cost of capital, right? If you remember, okay? So, but I'm going to go through some of the examples that are there. And I just want to find out from you if we can do the calculations together, which would be good to go for our practical, right? I hope that sounds good. Okay, so as you can see, the theory in the first part, some of them, I'm not saying that you need to memorize, but you might get theory in your task 2, right? You might get a question on a theory question. But like I said, think um, I think I speak with certainty somehow with regard to your task 2. You're not going to get more theory questions than your task 1. So expect less theory and more numbers, right? So just bear that in mind. But this theory is important, right? So you understanding the objectives of the working capital. And like I said again, the best way I can summarize for you the working capital, right, is the networking capital is the fact that you have the engine of any business out there, because it is how the business generate the cash, right? And that's why we spoke about that cash cycle. So if you have that already in your mind, that's it. That's a good grasp. That's a good understanding of what it's all about, right? And this is the very focal point of any for-profit business, right? Some we're not going to touch on the non-for-profit, but we are more interested in the for-profit. But even non-for-profit, some of the non-for-profit businesses will have also the same concept, right? All right. So this is very important. So you need really a very smooth operating cycle, right? That's very important. All right. Okay. So this again very important. You have return. Now, return is a rate. And the cost of capital is a rate. Can any one of you explain to me why we say this? For example, when I put such such an annotation in your notes to say returns must be greater than the cost of capital. What do you understand by that? Yeah, so we are in our chat, or if you want to unmute yourself, go ahead. And I'm not being heavy actually right now on the theory. I'm just this is just a couple of questions here and there, just to test your understanding, right? So when we say, okay, let's start by cost of capital. When we say cost of capital, what do we mean? What is that? The K. In many financial books, you will see K, which is the cost of capital, right? What do you understand by that? Awfully quiet here. Okay, so let me move forward. It's quite quiet here. I'm very scary. So the cost of capital, as you can see, it's the cost of borrowing, right? So when we are borrowing money, we are borrowing money. We have a cost that we need to pay. So it is the interest rate, right, that you are paying for borrowing the money. Now, you tell me what business out there is not borrowing some sort, is not borrowing money for its operations, right? That will be the vast majority of businesses, right? Unless you have very rich owners, right? But you are borrowing money from the banks and you need money. And remember, the two ways you acquire capital is through equity financing or debt financing, right? And a mixed or balance of the two, equity financing, debt financing. So I hope that that's clear, right? But when you're borrowing money and you need to repay, there is a cost, you know, over and above the amount that you borrowed. Is this clear? Thumbs up, thumbs down. If you can find the thumbs down. Yeah, go ahead, Connor. Question there.
No, sorry, I misclicked on the react button.
No, perfect, perfect. All right. So everybody understand that? That's clear. And again, like I said, I'm not trying to be too theoretical here. I'm not. I'm just these are as you can understand the basics of this chapter, right? So your return, right? So whatever business you have out there, and by the way, we could ask you to calculate that, right? So you should not be too shocked by it, right? When we say, can you calculate the return and can you compare which project is the best? So that will be basically the idea. We could provide you with three potential projects. We say, okay, these are the three potential projects, right? And this is the cost of each project, right? Cost of capital for each project, right? So now we ask you to calculate the return for that particular project, right? And so you will be able to look at the cost of capital. The cost of capital will be the same for the three projects most of the time because it will be more or less the same what you're going to borrow for your potential project. But depending, again, I'm saying more or less the same because depending on the project, should the project be riskier? And that's the reason why we say there must be a relationship between risk and return, right? So even the banks that are borrowing you funds will need to look at the kind of project you would like to engage yourself into. Is it a very risky project? And if it's a very risky project, banks are entitled to borrow you money at a higher interest rate. Okay, so I hope that that's very clear, right? But still, the concept is very simple, is that whatever return I am expecting will be greater than the cost of capital, right? So that not only I will be able to repay back the money, right? But also I'll be able to make a profit, right? So obviously, the best project will always be the project that has a higher return, right? So you understand also, remember um, the working capital ratio, very good ratio. If you remember, we had also a ratio, a solvency ratio. Remember in learning unit 2, and the working capital ratio, if you need to think about the working capital ratio, is basically that, is basically it, right? So it is your current asset divided by the current liability multiplied by 100, right? So that's your working capital ratio. Very important, right? Okay, you understand the relationship. Again, very basic. The higher the the risk, we should expect, you know, a higher return, right? So anybody who is investing in any project out there, if they are taking risks, more risks, the more the risks they're taking to invest in your project, the greater the return, right? I'm not going to go through all this. Over trading, please read it for yourself, but I summarize it for you quite well. And even in the Learning Unit 3 lecture, I emphasize also this, right? So it's quite important that you look now also at your vector collection period and your creditor settlement period, right? These two becomes important. Remember, we were calculating them in learning unit 2, right? Now we are making them practical. Why do we really actually need to get concerned with this, right? If you are settling your debtors before you collect the money, there will be a problem there with your cash cycle, right? And that's just logical, right? So you would like to be able to collect and collect enough from your debtors before you start settling your debt. You start settling your debt, all right? Is this clear? I know you'll go through the readings, but I just want to get an indication from you. Is this clear on the theory side? Are we fine? Does it make sense? Perfect. All right. So especially remember again, you are talking about the engine of the business, right? So the engine of the business is concerned with that current asset and current liability, right? So you're borrowing money to start a business or to um and the borrowing of that money could come in the form of credits that you get from your suppliers. Let's say you are a retail business, right? You are a small business, the owner of a small business venture, right? You do borrow money from your suppliers, and you don't even know. It might not be cash, right? It's just the merchandise that they're giving you and saying you will repay us. Okay? So don't just also see all the time the banks, that you need to go to the banks. And by the way, most of the time when you go to the banks, it is for uh, current non-current assets. These are long-term assets. If you would like to make an investment in long-term asset, you will need quite a lot of money, right? So that's how you would approach the bank. So again, please picture these scenarios in your head clearly, right? So by you taking merchandise on credit, you are borrowing money, right? Okay. So if you remember, this was the entire idea. I'm not going to dwell on this because this one, by the way, in the lecture, I ask you to practice on your own. But the idea is for you to be able to see these two: collection, the data collection period, and the creditor settlement period live, right? So when we have a 60-day collection period, but we need to settle our creditors within 30 days. There is a mismatch there, right? And so we look at what it does to your profits, right? So that's basically it. But again, you have the lecture, please go through it. But should you have a question here on this, just let me know. But this is quite clear. One of the things that I would like to touch on in terms of calculations, and I want to see that we are on the same page, is example 3.2. I love example 3.2 because you're going to get these budgeted questions where you have to look at multiple months ahead time, right? So this is very important. Again, I repeat, you will get it in your task two, sorry. You will also get it in your written exam. But you must always understand. And what is very important here is always to understand the timeline, how it is operating, the timeline, right? And that's why your note must be precise. And that's why I'm providing you with one note, and you can do your exercise and you put your note in order. When you are doing calculations, when you are doing a financial module, you will understand it's just a matter of you being well organized. And so that's even the whole idea of the OneNote, is to just provide you with the basic organization. You need to be well organized. All right. If you are somebody who is disorderly, you're not going to do well for when it comes to calculations or numeracy modules, right? But I wanted to touch on maybe this example. I added. This is just a new example. You're not going to find it in your actual notes. So this is something, for example, that I just added, right? And you will see that um, there is the budgeted total sales. And the sales, please pay attention, it will always be somehow divided between cash and credit. And I'm sure by now most of you have know about that, right? You're quite comfortable with it. You always need to ask yourself the question, but what is the percentage of cash? What is the percentage of credit, right? So when you're looking at a question like this, you obviously you must be so used to this kind of structure. But even if it's not the same structure, let it not put you off, right? Always check out to say, okay, uh, I think I see what's going on here. This is about budget, right? This is budget. They will provide me with months, right? So, but as you can see, somehow, if they are telling you that the budgeted total sales are from July to December, then we can fairly assume that we know somehow from April, for example, to June. So just before July, we already have certain things that we know for certainty happen, right? They happened. But remember, we always need to do projections. We need always to do forecasting. Although we use the term budgeted, right? But when it's about 3 months, 6 months, you know the difference between a forecast and the budget, right? Normally the budget looks at next year, right? So again, your theory, right? So your theory is there, is well structured. So automatically you look, you say, okay, so 75% of all the sales, I'm dealing with credit, meaning that the cash I would know. So if I do 25, why am I doing 25 again, guys? Can you write down quickly? Why am I doing 25? How am I getting that 25? Because you always have 100% minus 75. The total should always be 100%, right? Guys, you are too quiet. I'm getting worried here. Um, are we on the same page? Perfect. All right. So every time I'm seeing this, let me just make it bigger, yeah. So I know the total sell, all right? But remember, even this question could be dealing with the total purchases. So again, if they write purchases, it should not throw you off, where basically you start to say, well, but we never practiced. No, so on the purchases, no, we did. But also you must always remember, it could be the purchases. So your total purchases, 75% of your total purchases is done on credit, right? So that should not throw you off. But here we are talking about the first line item of your income statement. What is your first line item? That's your sales, right? So your sales, 100% of your sales, if they tell you, even in the middle of the night, that 75% of it is on credit, okay, very simple. 100% minus 75% will give me, and that should always be even your, you don't need even a calculator. It should be just your brain power, right? So 25% of this, I'm looking at cash. So meaning whoever was buying to, from me paid the first month, the month where they are paying, right? They are buying, they are paying cash 25%. 75% is on credit. What does credit mean? They are going to pay me later. They are taking it now. All right. So in your calculations here, so for all this that has been budgeted, and for this that we know, this is not budgeted. This is not budgeted. This is the actual sales that happen in April, May, and June. But this is cash. This is 25%. All right. So here we are dealing. Sorry. This is the 75%. My bad. Just a second here. This is the 75% because the 25% was paid cash. So what we're looking at here is the 75%. All right. Can we can we test that? You have your calculator. Can you take for July? What is the total for July? Come on, guys, you have your calculators. What is the total for July? 198, right? Multiply by 0.75. How am I getting 0.75? 75%. 75 divided by 100, right? 0.75. Isn't it this? 148. There you go. Because why? We are dealing with the credit. This is the credit. Why are we focusing on the credit? Is because that's what needs to be repaid. And that's why when we are doing a credit sales, right, like this, when we are doing this table, we want now to track according to the terms that we have, the agreement that we have with our datas. What is the agreement? Always now check. What is the agreement? Is that the following month after the sales, remember, the month of the sales is where money is settled in cash. And we know 25% is settled in cash. So forget about the month of the sales. You need now to look at beyond the month of the sales. So the agreement was the next month, right? The next month, they're going to pay back 60%. Now, if it is in July, what is the next month? So this table, if you understand this table, you're going to have fun because you will start from July. Uh, by the way, it's depend on the question, right? It depend on the question. Look at the question. Prepare a monthly schedule of budgeted receipts from datas for the period, all right, 1st July to December. If they say from the period June, then start from June. Answer the question. So in your test or exam, someone who's not paying attention, some of you would not be paying attention. You know what you're going to be doing? You're going to go all over the place here. We are not asking you for June. We are not asking you for March. We are saying start this budget from the period 1st July to 31st December. So you start from July, August, September, October, November, December. Does that make sense? So when we are talking about the schedule, prepare schedule, monthly schedule for the budgeted receipts, right? The money you're going to be collecting, you're going to be collecting money, but we are more interested of from July to December. How much you collecting in July? That's basically what we are saying in plain English, right? We are saying we wanna know how much you're going to collect in July, how much you're going to collect in August, September, October, November, December. Could you do that? All right. So that basically okay. But I need to know what are the terms. So we agreed with the daters that they will settle 60% in the following month and in the second month. So when we talk about the second month, it's the second month after this month. So if we are dealing with July, the next month is August. The second month after July, it is July. We skip August, which is the first month after July. This is the second month. Does that make sense? Ah, I'm liking that. Nafisa, can you give me a thumb up? Does this make sense? Really? Okay. If something is not making sense, just ask the question now, right? Or forever hold your peace. So ask the question now. But remember, what you should not do now. So you will do 60% of the 75%. So for you not to be confused, that's the reason why, first of all, you need to write the credit cells. What is the credit cells? It's 75% of these amounts. So I'm going to write them here so that I'm not confused. Why am I saying that? Because someone can say to me, listen, and that's to show you someone who is not understanding, right? Would say, okay, cool. All right. So I need to find the 60 for the first month after the month of sale, the 60%. I'm going to take 60% of 198, which is the total sales. And they say, wow, this is the answer. So for August, I'll put this amount. Well, but that's wrong. That's wrong. Why? Because sometimes you might forget this, this first thing here. So structure, put some order in your calculations and you will never fail. Because if you start first by, let me find all, let me find all, let me make this bigger, all the credit cells. Okay. So let me find all the credit cells. Just a second, sorry. this calculator of mine. Right. So I was saying it would be wrong if you're not structuring yourself, you might say something like this. 60% of the total sales for July is 189. So this is the amount, right? And you'll be wrong, right? But first you structure yourself. You say, okay, what is the credit sales? The credit sales 75%, right? So 0.75 multiply. Are you all able to see my calculator, by the way? Okay, sure, sure, sure. I was scared that I'm not sharing my calculator. Okay, you can see my calculator. So the reason why I share my calculator so that all of you can do this with me on your calculators, right? So I don't know how your calculator looks like, but everything should be the same, right? Multiply by the total. First of all, the total sales because I want to get the credit sales. And this is my credit cell, 1408. So I'm going to use this 1408 multiply by 0.6 to find what I'm going to pay, sorry, what I'm going to collect in the first month after the month of following the month of sale, after the month of sale. So it's going to be 89,000. Remember, we are simplifying here. That's why we are taking out the thousands. If it's difficult for you, keep the full number. Okay, so if it's going to complicate you, keep the full number. But we know the thousands is there, right? And here it is. So we know in the August, after July, I'm going to be collecting 89,100. And in September, I'm going to collect 25% of this, right? So I'm going to collect 25% of this, right? Okay, so makes sense. So 25%. So now remember again, I don't want you to be caught up in trouble, right? Whatever calculations you are doing, you are going to show that you are going to show us that calculation, right? So when you find this calculation, you would say, so I did, sorry, something is wrong here, right? So basically what I did is I did 25% or 25 divided by 100 multiply by what? By the one for July, 1408,000. Okay. So you need to put that in your calculations so that I know you are referencing. This is how I got to this answer here. Make sense? Perfect. All right. So basically, once you understand this schedule, then you can draw this table. You will never get wrong. And everyone adds the marks for something like this. It'd be like 25 marks. You know, this is something not to miss even something, you know, not even to lose any mark. Right? So please, 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 please ensure you understand this and you practice. When I say practice, is that you're going to take this question and do it by yourself and get the same table and compare that you got everything. So that is there for your calculations. Right? So I'm just going to take this out. I'm going to let you practice this By the way, this you will find in your test bank. You find a lot of questions, especially when you want to practice, you'll find a lot of questions in your test bank. Right, so moving on. This is a similar question. You are provided everything, right? You are provided with everything, even with the understanding. So when you're reading these questions, please ensure that you are reading the question carefully, right? Okay, let me try something. Yeah. Uh, right. Okay, so another thing is the 3% that are irrecoverable, irrecoverable, right? Sorry, irrecoverable. So pay attention to that. It's not it's not all the money that is recouped, right? It's not all the money. Plus, if you do pay in advance, sometimes you do get a discount. So for the 60, for example, for the 40% in this example, so to make sure that my datas are paying me on time, as we agreed, I can add something. I can add a perk there to say, listen, if you pay me on time, I will give you a discount. All right. So if read carefully the question to see if there is a discount. So from the 40%, you might be required to take out the discount, right? For in this example. So the second month, which is sorry, the first month after the sales or after the purchase, whatever it is, just pay close attention as to the amount that they're giving you as a discount, right? So if they give you a 5% discount, for example, so from the 65%, and they give you a 5% discount, so you're going to multiply. A 5% discount is 100%. Instead of you paying 100%, you will pay 95% because it's 100% minus the 5% that is from the discount. Is this making sense? So watch out for the discount. Okay, let me repeat that. Some of you were very quiet, right? Watch out for a discount. We can say, listen, you're going to pay back. If you pay the money, we're going also to give you a discount for a particular, let's say maybe for the first month, right? We're going to give you a 5% discount. So from the total, always remember the total is 100%. So if they tell you we're going to give you a 5% discount, so what you should understand is that the total is 100 minus 5%. So in actuality, I will be paying 95%. Is this clear? Is this making sense? All right. So everything that especially with regard to percentages, always think about the total. So I have a total and the total is 100%. Yeah. So if they're giving me a discount, it could be a 5% discount. What I'm saying is there's a 5% here that is being discounted. So what am I paying actually? If I'm the one paying, I'm paying 95% because I got a 5% discount. If somebody is paying me, so they will pay me 95% instead of the 100 because I provided them with a 5% discount. Again, this is just your basic ratios. All right, question 3.3, it's a good one. Where again, we just want to find out this will be an example again of accounting being present, right? So when you have accounting, you have, for example, this trial balance, and a good question will be what is debit, what is credit? And I put the minus sign for debit to say money is going out. So for example, when you are drawing, when you are withdrawing money from your accounts, or what you call your drawings, you are taking money out. Capital will be a plus because you are receiving money in. So whenever you get a capital, you are getting money in the business. All right. Is this clear? So I want you to play, for example, this exercise by yourself, just to remind yourself that you understand the principle of what is an outflow, what constitutes money going out, and what constitutes money going in. When you pay your telephone bill, it's money leaving the company. It's a minus. So all your expenses will be a minus. Your incomes will be a plus. Right. Okay. And I think we can finish with this part, which is very, very important. There is a good question, question 3.4, and I want you to work on this question. You can do the good thing with when a question is there and you have a solution is that you can ignore the solution and just use your textbook and do the question by yourself and see if you're getting it right, right? And then after that, but this will be your normal time value for money, all right? Let me repeat again. You must remember it's finance, and you must remember time value for money, okay? Money over time, because of the interest we pay, right? Money increase, right? In terms of investment, especially. And that's a good question, right? Because somebody has been investing, a young man has been investing 100 Rand every single month from the time he was 18 to the time to his 20th birthday, right? So I'm just paraphrasing quickly the question, right? Okay. So what they tell us, and that's what I want all of you to do. So every time, even when you're asking me a question, I will ask you, if you're not getting it right, I would say, where is your time value? Where is your time value? Did you draw a line? That's the reason why I always draw a line, right? So basically, this question is saying that when he is 20, this is the amount of savings that it has grown to. If we have to count rand per rand of what he invested, it's 2,400 rand per rand. But because there have been an interest, an effective interest rate, right? Remember, there's a 12% effective interest rate. So the savings will not be exactly what he invested, not the exactly 2,400. It will be slightly higher, 2,697. All right. So, but what they want, the question here addressed this to say that at 20, when he gets to 20, this is the amount of money that is in his savings because he's been diligent from the age of 18. He was saving 100 Rand per month. All right. So far, does this make sense? The same effective annual interest rate applies. By the way, your second tutorial that I shared, I shared a tutorial on this, on how you calculate your effective interest rate. Okay, there's a difference between your nominal interest rate and your effective interest rate. Okay? Your nominal interest rate is a quoted rate, what they quote you or what you quote people. You can say, I'm going to lend you money at a 12% interest rate compounded monthly. Now, what does the effective interest rate means? Effective interest rate is we need to take the rate that you have quoted me, that is compounding every single month. We need to put it on the year basis, right? So that we can understand what exactly is the interest rate you are giving me. All right. Again, it is in your it is in the lectures, the lecture as well as the tutorials I've shared with you. Go and practice this, right? But this again, I just want to touch on this question of time value for money. Very important one, right? So on your calculators, remember it's all about your calculators. This amount, when this young man is at 20 year old, at 20 years, right? This amount is your present value. The question asks you, what will be the future value of this amount when is 65? Okay. So as you can see, um, if we start from, if I'm not mistaken, so at 65, from 20 to 65, there's 45 years, right? This was an example if it is, you have to take 65 years. So don't be confused with this one here. So this was an example that I gave previously. If you have to use all the, but so what you're going to do with your calculators is that you're going to do 45, right? Yeah. So remember, sorry about my, a bit difficult to select when I have this. All right. Yeah, now I can select. Okay. So whatever calculations that you are doing, right? Remember the future value. Must always remember 1 plus what the interest rate is. So if we are talking about a 12% interest rate, 12%, 12%, remember 12 divided by 100. I know, it's are tired of me repeating this, but I know why I'm repeating this because some of you will always, and that's why if I ask you to show your works, your steps, right? I need also to show you the steps all the time that I'm talking to you, right? So you understand how you get the 12%, right? And the exponent here, the exponent should always be the number of years, right? So that's why when you see somebody write it like this, 1, comma 12, they are not wrong. It's because they take the 1 plus comma 12, right? And to the power of 45, for example, right? So by doing this, you will find what the future value will be in a certain number of years. Is that clear? For some of you who knows the present value and the future value, I know it's only boring repeat, but for 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 any one of you who is new to future value, is like, wait a minute, what is this future value? So that's a quick breakdown, right? So in the future, time value for money. Is this making sense? Okay, so that was not my focal point, by the way. My focal point was on this. And I'm going to touch on this last example, and I will let you to practice. And the practice, by the way, we keep in touch. Whatever you're practicing, write it down. And if certain things are not making sense, take a screenshot, send it to our uh, WhatsApp group. Let's continue to practice, right? We're not going to practice everything on a session like this, right? However practical the session is. But this is the kind of questions you will get. You will get it in your test too. Mark my word, you will get it in your final exam, right? So you will be provided rates, right? So you are going to borrow money, for example, you will have different banks that will provide you different rates, right? Different cost of capital, for example, right? So for example, for a triple A bank is providing you a 50%. So you understand the reason why we are calculating the effective annual rate. Why are we calculating that rate? We are calculating because if you just say 50%, 14%, 14%, obviously I will say, oh, the first one, um, I'm gonna get more if someone is borrowing from me. I'm going to get paid more. I'm going to get paid 15%, so that's good. But if I am the one borrowing money, you understand? I am going to the bank. I'm gonna choose the lesser. So I wanna pay the least. The least is the best. I hope it's clear. So if someone is lending money, more interest, the better. The more, the better. Because if I charge you more and you pay me more, it's good for me. But for the one who's borrowing, the one who's borrowing is interested in borrowing money at the least cost possible. That makes financial sense, right? I hope that makes financial sense, right? Um, is that making sense, right? So for this one, for example, you are going to the banks and the banks. So obviously the least is the best. So I will always, I will choose triple C. But now there is a catch here. There is a compounding that is taking place. So then I don't know. It's compounded daily. Then I don't know what is the actual effective rate. The effective rate puts everything on the same level. That's why we call it the effective annual rate. So if we have everything on the same timeline, then we can compare. Right now, we cannot compare because one is compounded biannually, so every 6 months. One is compounded quarterly, every 4 months. One is compounded every day. So it's not on the same timeline. And that's why we need to put it on the same timeline. And that's the reason why we are calculating the effective rate, right? So I've provided it to you here to make it quite simple for you. Effective annual rate equal 1 plus the quoted nominal rate divided by M. And as you should know, M is the number of periods, meaning if it is compounded quarterly, it means that how many periods? Quarter. There's 4 quarters in a year, right? So the M is the number of periods. So you will take the quoted nominal rate divided by, if it's quarterly, by 4. Does that make sense? So look at the brackets. The brackets, very important to do the calculations in the parentheses first, then in the brackets. In the parentheses first, then in the brackets. Okay? Is that making sense? I break it down for you. For example, for this quarterly, is this the quarterly one or the monthly? Okay, the monthly one is 12, right? The quarterly is 4 periods. Okay, so we take, if it's 10%, we take comma 10%, 10 divided by 100, it's comma 0, comma 1. Divided by the number of period is what? So you start by this. So I'll show you before we close so that we are on the same page, right? I know that's quite boring, but let's just do this. So this is the 10% divided by 12 plus 1. So you start by everything that is first in the parenthesis and then the bracket. So this tells us everything that is in the bracket. Now, once we've done everything that is in the bracket, because we added the 1, right? We need now to, no, not square it. Sorry. Made a mistake there. Not square it. Yeah, let me start again. 0.1 divided by 12, the number of periods, plus 1. And I need to compound it to what? Compound it to 12. Because 12 periods, right? Here is the 12, right? Okay, I get a rate, then I minus 1. Minus 1. It's a formula, right? Okay, now multiply by 100 to find the percentage. Okay, so this will be 0.08. Okay, 0.08. Right. Makes sense? Are we good? But what I've just done here, here is the calculation, right? So for example, for AAA, it's biannually. So that's the reason why the 0.15, because it's a 15%, 15 divided by 100, 0.15 divided by 2, because it's compounded biannually. Once I get the answer of what is in the parenthesis, then I add plus 1. Making sense? Yeah? I will show again, right? 0.15, right? Divided by 2, okay? Plus 1. We can square it because we can square it. Sorry, multiply by 2, right? Oh, am I right here? No, you should not square it. Something went wrong here. 0.15 divided by 2 plus 1. Are you here? There we go. There we go. And then what is the final operation? Minus 1. Okay? Okay? Now, this is a decimal. It's not the actual percentage. How do you do to get the actual percentage? You multiply by 100. So when you do this, you are practicing. So just make sure. So now we can basically see which one is the best. Because once we put everything on the annual, effective annual interest rate, right? Effective annual rate, then we can choose the one that is lower. Because we want to pay back less, not more. Who want to pay back more? So triple A will actually be a good pick. Okay? Is that clear? Any questions? All right, guys, that's not the end.